Have you ever stopped to think about where money actually lives? Not in your wallet, not under your mattress, but in a system so complex that most people never question how it works. Here's what nobody tells you. Every time you swipe your card, check your balance, or pay a bill, you're participating in a centuries-old system that literally holds our entire economy together, and if it broke tomorrow, society as we know it would collapse within days. Here at Simple Money, we've spent years breaking down how financial systems actually work. And today, I'm going to reveal how banking went from simple money storage to becoming the invisible infrastructure that makes modern life possible. By the end of this, you'll understand why banks aren't just buildings where money sits. They're the circulatory system of the entire economy. And once you see how it works, you'll never think about your bank account the same way again. Here's what's really happening. Most people think banks are basically fancy safes. You put money in, they keep it secure. You take money out when you need it. Simple, right? Wrong. That's not even close to what banks actually do. And this misunderstanding is exactly why most people don't realize how fragile and yet how essential the banking system really is. Think about your last grocery store trip. You probably used a debit card or credit card. That transaction happened in seconds. Money moved from your account to the store's account instantly. But here's what you didn't see. Behind that simple swipe, dozens of banks, networks, and financial institutions communicated with each other. They verified your identity, checked your balance, authorized the transaction, moved the money, recorded everything, all in the time it took you to grab your receipt. Now multiply that by billions of transactions happening every single day around the world. Trillions of dollars flowing through this system constantly. And it all works so smoothly that you never think about it. Until it doesn't. Remember when a major bank's computer system goes down? Even for a few hours? People panic. They can't access their money. They can't pay for things. Businesses can't process sales. Everything grinds to a halt. That's because banking isn't just about storing money anymore. It's about moving money. And in a modern economy, if money stops moving, everything stops. The first way banking became essential is what I call the multiplication effect. Here's something that will blow your mind. When you deposit $100 in your bank, that money doesn't just sit in a vault with your name on it. The bank takes that $100 and lends out about $90 to someone else. Maybe for a car loan. Maybe for a business. Maybe for a mortgage. But here's where it gets wild. That $90 doesn't disappear from your account. You still have your $100. You can still spend it whenever you want. Meanwhile, the person who borrowed the $90 now has $90 they can spend. So your original $100 just became $190 in the economy. And it doesn't stop there. The person who borrowed that $90 might deposit it in their bank. Then their bank lends out about $81 to someone else. Now we're up to $271 in the economy from your original $100. This is called fractional reserve banking. And it's how banks literally create money out of thin air. Legally, think about what this means. Without banks doing this multiplication magic, there would be way less money flowing through the economy. Businesses couldn't get loans to expand. People couldn't buy homes. Economic growth would slow to a crawl. The entire modern economy depends on banks creating money by lending out deposits over and over again. It's not just useful, it's absolutely essential. Now here's the psychology behind why most people never realize this. We think of money as a physical thing, like gold bars or cash, something that exists in a fixed amount. But modern money is mostly just numbers in computer systems, and banks are the institutions that make those numbers grow and flow through the economy. The people who understand this see banks differently. They're not just places to store cash, they're engines of economic growth. They're money multipliers. The second way banking became the backbone is what I call the trust infrastructure. Every transaction you make requires trust. When you pay someone, you trust that the money actually transfers. They trust that the money is real. Everyone trusts that the system works. But here's what's really happening. You're not actually trusting the individual person or business. You're trusting the banking system between you. Let me give you a specific example. Imagine you're buying a house. You're handing over $300,000 to a complete stranger. That's terrifying, right? But you don't actually hand them cash. You don't even hand them a check anymore. Your bank transfers money to their bank. And everyone trusts this will work because banks have spent centuries building systems and regulations to make sure it works. The seller trusts they'll get paid. You trust you'll get the house. The real estate agent trusts they'll get their commission. All because banks sit in the middle, guaranteeing everything. Without this trust infrastructure, modern commerce would be impossible. Every transaction would require face-to-face cash exchanges, no online shopping, no international trade, no business loans, nothing. Think about buying something from China. You've never met the seller. They've never met you. You don't speak the same language. You live on opposite sides of the planet. But you click buy, and your bank moves money from your account through an international network to their bank in China. They ship the product. Everyone trusts this will work. That's the banking system doing its job. Here's the uncomfortable truth. We've built our entire civilization on trusting banks to move money reliably. If that trust breaks, everything breaks. And banks know this. That's why they spend billions on security, on regulations, on systems to prevent fraud. Because once trust is gone, the whole system collapses. The people who succeed in understanding finance get this. They understand that banks aren't just businesses. They're the trust layer that makes all other businesses possible. The third critical function is what I call the economic shock absorber. When something goes wrong in the economy, banks are supposed to cushion the blow. They're like the suspension system in a car, smoothing out the bumps so passengers don't feel every pothole. Here's how this works. Imagine there's a recession. Businesses are struggling. People are losing jobs. Everyone's scared. In this situation, people stop spending. They hoard cash. They pay off debts. And this makes the recession worse, because when people stop spending, businesses lose revenue, which means more job losses, which means less spending. It's a vicious cycle. Banks are supposed to break this cycle. During recessions, banks can lower interest rates on loans. They can work with borrowers who are struggling. They can keep money flowing through the economy even when people are scared. This doesn't always work perfectly. Sometimes banks make things worse. But in theory, banks are supposed to keep the economy stable by adjusting how freely money flows based on what's happening. Think about the 2008 financial crisis. Banks failed at this job spectacularly. They actually caused the crisis by making too many bad loans. But even then, the government's response was to save the banks. Why? Because without functioning banks, the economy would have completely collapsed. Not just a recession, a full-blown depression where money stops moving entirely. The banking system is like the electrical grid. When it works, you don't notice it. But if it goes down, everything that depends on it fails immediately. Now here's what most people completely miss. Banks don't just respond to economic conditions. They create economic conditions. When banks are willing to lend freely, businesses expand. People buy homes, the economy grows. When banks tighten up and stop lending, the opposite happens. Growth slows, opportunities disappear. So banks aren't just reacting to the economy, they're actively shaping it every single day through their lending decisions. The psychology here is fascinating. Most people think the economy is this natural force, like weather. Sometimes good, sometimes bad, but beyond anyone's control. But banks are actively steering the economy through how much they lend and to whom. They're not passive observers. They're active participants controlling how money flows. The fourth way banking became essential is what I call the information hub. Banks don't just move money. They track everything, every transaction, every account, every loan. And this creates an enormous database of economic activity. This information is incredibly powerful. Banks know who's spending money and on what. Who's saving? Who's borrowing? Which businesses are growing? Which are struggling? And this information helps the entire economy function better. When a business applies for a loan, the bank can check their history. Do they pay bills on time? Do they have steady income? This helps banks make smart lending decisions. Without this information infrastructure, lending would be impossibly risky. Banks would have no way to tell good borrowers from bad ones. So they'd either lend to nobody or charge everyone extremely high interest rates to cover the risk. Think about your credit score. That's banks sharing information about you with each other. And while it might feel invasive, it's actually what allows you to get loans at reasonable rates. If banks couldn't track your payment history, they'd have to assume you might not pay them back. So they'd either refuse to lend to you or charge you 50% interest. The information infrastructure that banks have built allows for something called price discrimination. Not in a bad way, in a way where responsible borrowers get better rates and risky borrowers pay more. This makes the whole system more efficient. Money flows to the people and businesses most likely to use it productively. Here's what makes this even more crucial. Banks also share information with regulators. The government needs to know if the banking system is healthy, if banks are taking too many risks, if there's a crisis brewing. Without banks tracking and reporting all this information, the government would be flying blind. They wouldn't know when to intervene, when to adjust policies, when to sound the alarm. So banks have become the central nervous system of the economy. They're not just moving money, they're sensing, tracking, and reporting on every financial pulse in the system. The fifth function is what I call the payment rails. This is probably the most overlooked but most critical function of all. Banks have built the infrastructure that allows money to move from person to person, business to business, country to country. These payment rails are incredibly complex. When you pay your electric bill online, your bank talks to the utility company's bank. They verify everything. Move the money. Record the transaction. All automatically. Multiply this by every bill payment, every purchase, every paycheck, every business transaction happening constantly. Billions of payments flowing through these rails every single day. And here's what's crazy. This infrastructure is so essential that if it stopped working, society would break down within days. Can't pay for food? Grocery stores close. Can't pay employees? They stop working. Can't pay suppliers? Supply chains collapse. Think about how different this is from 100 years ago. Back then, most transactions were cash or checks. If the banking system failed, people could still exchange physical money. Life would continue. But today, almost everything is digital. If the payment rails go down, there's no backup system. We're completely dependent on banks to process transactions electronically. Let me give you a real example. In 2013, a major payment processor had a system failure for just a few hours. People couldn't use debit or credit cards. ATMs didn't work. Grocery stores had to turn customers away. Gas stations couldn't process payments. Businesses lost millions in sales. And this was just a few hours. Imagine if the entire banking system's payment infrastructure failed for a week. It would be catastrophic. Food shortages, riots, complete economic paralysis. This is why governments consider banks to be critical infrastructure, just like power plants and water systems. Because modern society literally cannot function without them. The people who understand this see banks completely differently. They're not just businesses trying to make a profit. They're essential utilities that keep civilization running. But here's what nobody wants to admit. This also makes banks incredibly powerful. They control the infrastructure that everything else depends on. If banks decide not to process payments for a particular person or business, that person or business is essentially cut off from the economy. They can't buy. They can't sell. They're frozen out. This has actually happened. People who banks consider too risky sometimes get their accounts closed. And without a bank account in modern society, you're essentially invisible to the financial system. So banks have gone from being optional services to being mandatory gatekeepers. You need them to participate in modern economic life. Let me tell you about Marcus. Marcus is in his 30s, works a regular job, uses his bank for direct deposit and bill payments. Pretty standard. But Marcus thinks about his bank the old way. It's just where his money sits, a safe place, nothing special. When Marcus needs to make a large purchase, he doesn't think about interest rates or terms. He just takes whatever loan the bank offers. He doesn't shop around, doesn't negotiate. When his bank changes fees or policies, Marcus doesn't really pay attention. He figures it doesn't matter much, just a few dollars here and there. But here's what Marcus doesn't realize. By not understanding how essential banks are to the economy, he's missing huge opportunities. Banks need customers. They compete for deposits and for borrowers. If Marcus understood this, he'd have leverage. He could negotiate better rates, switch banks for better terms, use the system to his advantage. Instead, Marcus treats his bank like a utility he has no control over, just something he has to accept. Over 10 years, this passive approach costs Marcus thousands of dollars in unnecessary fees and higher interest rates. Not because he's stupid, but because he doesn't understand how the system actually works. Now let's talk about Jennifer. Jennifer is also in her 30s. Similar job, similar financial situation. But Jennifer spent time learning how the banking system works. She understands that banks are essential infrastructure competing for her business. So Jennifer shops around. She compares interest rates on savings accounts. She negotiates her mortgage rate by getting quotes from multiple banks. She knows exactly what fees she's paying and why. When Jennifer needs a car loan, she doesn't just go to one bank, she applies to 3. Then she uses the competing offers to negotiate the best rate. Jennifer also understands that banks create money through lending. So she's strategic about debt. She uses low-interest loans for investments that will grow. She avoids high-interest debt on things that depreciate. Over the same 10 years, Jennifer saves thousands of dollars. Not because she's smarter than Marcus, but because she understands the system and uses it strategically. Same starting point, wildly different outcomes. All because of understanding how banking actually works. Here's what most people don't realize. Banks aren't neutral institutions just providing a service. They're businesses competing in a marketplace. And once you understand that, everything changes. You're not just a passive customer. You're someone with options, with leverage, with the ability to make the system work for you instead of against you. It's not about being anti-bank. Banks provide essential services. The whole economy depends on them. But understanding their role gives you power. You can negotiate better terms. You can shop around. You can avoid unnecessary fees. You can use banking services strategically instead of just accepting whatever you're offered. The difference isn't about financial knowledge or being good with numbers. It's about understanding the system, understanding that banks need you as much as you need them. And once you see this, you can't unsee it. Every interaction with your bank becomes an opportunity to get better terms, save money, or use their services more strategically. Let me bring this all together. The multiplication effect means banks create money by lending deposits repeatedly. The trust infrastructure makes all modern commerce possible by guaranteeing transactions. The economic shock absorber function helps stabilize the economy during crises. The information hub tracks and reports economic activity. And the payment rails process billions of transactions that keep society functioning. These aren't just interesting facts. They reveal that banking has evolved from optional money storage into absolutely essential economic infrastructure. Without modern banking, the economy would collapse within days. Not slowly decline. Collapse. But here's the empowering part. Understanding this gives you real advantages. You can negotiate better rates because you know banks need customers. You can use debt strategically because you understand how banks create money through lending. You can protect yourself during economic uncertainty because you understand how banks respond to crises. And you can avoid being taken advantage of because you understand the system. The question isn't whether you'll use banks. You have to. They're essential infrastructure for modern life. The question is whether you'll use them passively, just accepting whatever you're offered, or whether you'll understand the system well enough to make it work in your favor. Because the people who build real financial security aren't the ones who avoid banks or don't trust them. They're the ones who understand exactly what banks do, why they're essential, and how to navigate the system strategically. What's your next interaction with your bank going to look like? Are you going to approach it differently now? And more importantly, what opportunities have you been missing because you didn't understand how the system really works?